dark side of the boom. Streaming now.
World Business Report here on News 9 Live. I am Krishna Kumar. Now, it has been a standout month for the U.S. economy and the U.S. markets. The Dow achieved its highest close of the year, and that's reflecting robust growth and investor confidence. S&P and NASDAQ too notched up their biggest monthly gains since July 2022. November was the Dow's best month for gains since October 2022. This Reuters report tells you more.
The Dow Jones Industrial Average closed at its highest level this year on Thursday as investors crossed the finish line of a banner month for U.S. stocks. The Dow gained nearly 1.5%, the S&P 500 added 0.4%, but the NASDAQ dipped by roughly 0.2. The S&P and NASDAQ notched their biggest monthly percentage gains since July 2022. November was the Dow's best month for percentage gains since October 2022. And Mark Lucchini, chief investment strategist at Janney Montgomery Scott, says stocks have more room to run.
We think we're in a bull market for stocks, given the fact that the economy continues to operate at a pretty heady pace. On balance, that leads us to believe that equity prices will certainly oscillate from time to time as we digest probably not necessarily a linear improvement in inflation or the Fed's hawkish stance necessarily be removed completely anytime in the near future, which is probably going to keep market participants on their heels for a little while. But nonetheless, we think ultimately is supportive of equity prices and therefore remain quite constructive on stocks for 2024.
Among data released Thursday, the Commerce Department's closely watched personal consumption expenditures report showed inflation is cooling as expected, along with consumer spending. The data reinforced expectations that the Federal Reserve has completed its rate hiking cycle. In company news, shares of Salesforce jumped nearly 9.5% following the company's higher-than-expected profit forecast based on solid demand for its cloud services. Ford shares slid 3% after the automaker set the cost of a new labor deal at $8.8 billion and cut its full-year forecast. And data cloud company Snowflake surged 7% after it forecast fourth-quarter product revenue above Wall Street estimates.
Elon Musk's Tesla has unveiled Cybertruck with a starting price of around $61,000, setting a new standard in the electric vehicle market with futuristic design and advanced features. Bear in mind, this is not a car, but an electric truck. Take a look.
Finally, the future will look like the future.
On a darkened stage in Austin, Texas, Tesla CEO Elon Musk introduced the long-delayed Cybertruck and delivered the first new electric pickups to customers. The low-cost model starts at roughly $61,000, more than 50% higher than the price Musk had touted in 2019. He said the Cybertruck has a 6-foot-long, 4-foot-wide truck bed, 2,500 pounds in payload capacity, 11,000 pounds towing capacity, and a 17-inch ground clearance.
It's basically an incredibly useful truck. It's not just some grandstanding showpiece like me.
The event comes weeks after he tempered investor expectations, citing problems in ramping production of what he called a radical product. Cybertruck, Tesla's first new model in nearly 4 years, is critical to its reputation as a maker of innovative vehicles. At a time when the company is battling softening electric vehicle demand and rising competition, Cybertruck is also key for generating sales, though not to the extent of the company's high-volume Models 3 and Y. According to Tesla's website, the low-cost truck won't be available until 2025, while higher-priced models will debut next year. Experts say Cybertruck's new body material and unconventional futuristic styling add complexity and costs to production and threaten to alienate traditional pickup buyers who focus on utility. Tesla tried to display the usefulness of the new vehicle in a video it ran, showing the Cybertruck pulling a 40,000-pound sled farther than trucks from Ford and Rivian. It has drawn more than 1 million reservation holders who have put down $100 as deposits.
Now, keeping it with Elon Musk, he's voiced his frustration at companies exiting Twitter, now called as X, due to anti-Semitism, and he's passionately condemned their actions and advocated for unity against discrimination, this at a time when ad revenues are set to completely empty out of X platform.
Elon Musk isn't about to make up with advertisers. In a fiery interview Wednesday at a New York Times event, he cursed at firms who quit social network X over anti-Semitic content. He told such brands to go F themselves. And he appeared to single out Disney chief Bob Iger as one target. The company was among those to pull all ads on X after Musk posted in support of a user who repeated an anti-Semitic conspiracy theory. Speaking earlier at the same event, Iger said that association with X was not a positive one for us. Other firms, including Warner Bros. Discovery and Comcast, have also withdrawn marketing. On Wednesday, Musk bristled at suggestions that he was anti-Semitic, but did offer a note of contrition. He described his post as the worst he had made in a long history of foolish tweets. But one marketing consultant said his new tirade would be the closing chapter for brands doing business with X. Musk does not appear deterred. He says that if X fails because of an advertiser boycott, then so be it. Let the chips fall where they may, he said Wednesday. X is, however, suing the Media Matters organization, which has claimed that ads on the social network are appearing next to content promoting Nazism.
Keeping it in the US, where retailers are adopting quote-unquote keep it policies for this holiday season, encouraging customers to retain returned items rather than disposing of them. And that was aimed at reducing waste and promoting sustainability. Shifting focus to the world of artificial intelligence, which is celebrating a milestone. The viral AI chatbot ChatGPT is commemorating its first year of existence, a year which has seen revolutions taking place in the world of artificial intelligence and has revolutionized virtual conversations per se, apart from all the drama surrounding Sam Altman.
OpenAI's viral chatbot ChatGPT launched on November 30th, 2022. In the past year, its uncannily human-like responses have taken the world by storm. While it has answered millions of user prompts, its growing influence has also sparked serious inquiries into, and movements against, the role of AI in society. It's a conversation that also played out in a tumultuous boardroom battle that saw the sudden ouster and return of CEO Sam Altman. Here's a look at the impact ChatGPT has had on the technology sector. ChatGPT became the fastest-growing software application in the world within 6 months of its debut, sparking the launch of rival chatbots and a bevy of startups. Its competitors include Bard, Anthropic's Claude, Character AI, and Microsoft's Copilot, which have seen a surge in users. But ChatGPT commands the lion's share of the market. ChatGPT's launch sparked massive investments from top tech players. Microsoft and Alphabet have invested billions to improve their cloud computing capabilities and take on more AI workloads as businesses embrace such tools. Chipmaker NVIDIA became the first and only chip company to join the $1 trillion valuation club. It's widely considered to be the biggest winner of the AI boom, due to its position as the key supplier of the chips used to power ChatGPT and other generative AI applications. With these applications running mostly on the cloud, vendors of cloud computing services like Microsoft, Amazon, and Alphabet have also seen their shares surge. OpenAI and its backer Microsoft have been slapped with several copyright lawsuits. Authors including John Grisham, George R.R. Martin, and Jonathan Franzen are suing over the alleged misuse of their work to train AI systems. The companies have denied the allegations.
Moving on to China, where facing a financial crisis, China's largest property developer Evergrande has unveiled a final ditch effort to tackle its mounting debt burden. And what is that effort all about? What is the strategy over here to save Evergrande and China's property market? This report tells you all about it.
China Evergrande has made a last-minute effort to fight off the threat of imminent liquidation. 3 sources close to the matter said the property firm has put forward a debt restructuring proposal, but the sources said creditors were unlikely to accept Evergrande's new pitch. They cited low recovery prospects and growing concerns about the future of the world's most indebted property developer. Evergrande did not respond to a request for comment. The firm has more than $300 billion in liabilities and is representative of a crisis in China's property sector. Authorities have tried to support the industry as troubles at various developers have worried global markets. Evergrande defaulted on its offshore debt 2 years ago. This coming Monday, the Hong Kong High Court will rule on a liquidation petition. This week, sources said Evergrande offered to swap some debt held by offshore creditors into equity in the company and 2 Hong Kong-listed units. They said it also offered to repay the rest with non-tradable certificates backed by offshore assets. A collapse of Evergrande has been a major concern for global investors while the Chinese economy struggles. Property sales have slowed in the country and hundreds of thousands of homes are unfinished. If the Hong Kong court orders Evergrande's liquidation, appointed liquidators would take control and arrange to sell the company's assets to repay its debts.
Now, OPEC Plus's consensus on production cuts in crude oil has failed to deter market skepticism, and that's led to a fall in crude oil prices despite the agreement aimed at stabilizing the oil market. More in this report.
The group of oil-producing nations known as OPEC Plus is cutting supply by nearly 2 million barrels a day beginning next year. The decision came during a virtual meeting Thursday to discuss 2024 output amid concerns the market faces a potential surplus. OPEC Plus, which is led by Saudi Arabia and includes member allies such as Russia, pumps more than 40% of the world's oil. The group's current output already reflects cuts of about 5 million barrels a day, aimed at supporting prices and stabilizing the market. Oil prices first rose on the news by more than 1%, but by Thursday afternoon had reversed course, with U.S. crude dropping by nearly 2.5% to under $76 a barrel. One expert told Reuters there is a high degree of skepticism on how individual OPEC Plus members will reach their voluntary cuts, going so far as to call the plan sketchy. He added that the UAE, for example, is supposed to be increasing production by 200,000 barrels per day by 2024. OPEC Plus is focused on lower output with prices down from nearly $98 a barrel in late September and concerns brewing over weaker economic growth in 2024.
Now, it's not just property developers in China. Europe's property giant Siga has grappled with mounting debts and is now signaling a downfall and uncertain future for the company amidst all its financial struggles. Take a look at this.
It's the biggest casualty so far of a European property crash. Real estate giant Siga declared insolvency on Wednesday. It's the firm behind high-profile projects and department stores across Germany, Austria and Switzerland. The company also runs Germany's top high street chain, Galeria, and is an owner of New York's famous Chrysler Building. Siga collapsed into insolvency after last-ditch attempts to find fresh funding failed. Creditor groups say its debts amount to about $5.5 billion. Now investors are worried the fallout could spread across Europe's embattled property sector. Austrian bank Raiffeisen, one of the firm's biggest lenders, has warned real estate prices could sink if Siga starts selling assets. The sector's troubles come after the steepest rise in borrowing costs in the 25-year history of the euro. That has caused a deep slide in property prices in Germany, where much of Siga's business is anchored. Analysts say its problems threaten to leave deep scars on the country's shopping streets. The crisis has also halted work on Germany's tallest building, a 64-story skyscraper in Hamburg. Siga is majority controlled by Austrian magnate René Benko, while other rich individuals have minority stakes. Dozens of banks, including Switzerland's Julius Baer, have lent heavily to the firm.
Now, keeping it with the Eurozone is experiencing an unexpected and substantial decline in inflation. And that is raising economic concerns and prompting the analysis of what is the potential implications of falling inflation. Take a look at this.
Eurozone inflation fell far more than expected in November. Consumer price growth in the 20 nations sharing the euro currency dropped to 2.4% this month. It was down from 2.9% in October and below expectations of 2.7%. This rapid inflation slowdown puts the European Central Bank in disagreement with investors. It appears both see a greatly different way ahead for consumer prices and ECB interest rates. The ECB argues underlying dynamics are more stubborn than they appear. It also believes inflation will come back above 3% next year and finally hit its target of 2% in 2 years. That requires the bank to hold its deposit rate at a record 4% high for an extended period. But investors have increasingly ignored ECB President Christine Lagarde's guidance for steady rates for several quarters. Traders on Thursday bet that the first interest rate cut will come by April. A key reason for the difference is that the ECB's own projections have a poor track record. It's been forced several times in recent years to abandon its own guidance after first pushing back on market expectations. Economists say growth is weaker than the ECB expected and argue the labour market is softening and credit demand has fallen away, which points towards disinflation. But some economists argue modelling current inflation is difficult because corporate profits are the main driver, not wages, as in normal examples of rapid inflation. Separate figures on Thursday show German unemployment rose in November and the French economy was shown to have contracted in the third quarter. That has raised investor bets that the ECB will cut interest rates early next year.
Away from all of that to the world of entertainment, where it's time for the 2023 Mama Awards, which will witness a prestigious lineup of K-pop stars will be dazzling at the awards function, offering an electrifying performance for fans across the world.
Rise を応援するために来ました。I came here to cheer on Rise. Rise is cool. The members all good at dancing and singing. They're an amazing group. I love them. 大好きです。
And that's all we have time for in this edition of World Business Report. Thank you so much for watching. Keep it with News 9 Live. Literally every major power in the world is gearing up with its own digital currency.